On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. And finally, we must reduce the risk of this happening again. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again. Americans can rest assured that our banking system is safe.
What did we just do? Did we just nationalize the banking system?
Hi, welcome back to Joe Blogs. In this episode, I want to look at the continued fallout of the failure of Silicon Valley Bank. Over the course of the last week, we have seen emergency measures being brought in the USA, which were put together at very short notice in response to the bank runs that had occurred at Silvergate Bank, Silicon Valley Bank, and Signature Bank. Now, the measures that were brought in by the US Federal Reserve were designed to protect depositors and to bring calm back to the markets because panic was starting to spread across the banking sector in the USA, and this could have developed into a major crisis. But in today's video, what I want to do is lift the bonnet on these changes and talk about what the potential longer-term implications of these changes will be. So I'll provide you with a quick recap of how the bailout facility works. We'll talk about the associated increases in regulations that are now likely for the smaller banks in the USA. We'll have a look at how the collapse of SVB has been handled in other countries. And specifically, we'll have a look at the deal that was struck between the UK government and HSBC. Now, one of the reasons for the failure of Silicon Bank was that it was short of cash and therefore had to sell some of its bonds, which were trading below par, and it announced to the market that it had booked a $1.8 billion loss on the sale of that portfolio. And I'll provide you with the details of exactly who purchased that portfolio, who benefited from the huge loss that SVB booked. And then finally today I'll wrap up with my summary as to what I think the longer term implications of all of the changes that have been introduced as a result of SVB's failure will be. Now, before we go on any further today, I want to talk to you about today's sponsor, Atlas VPN, and to let you know about their amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. If you use the internet without any form of protection, you leave yourself exposed to tracking, hacking, and advertising. Using Atlas VPN protects you from all of these. Atlas VPN provides you with comprehensive security and is used by more than 6 million people worldwide. So it's fantastic news that it will protect you from hacking and tracking and data breaches. But what's also great news is that it can save you money and open up a whole new world of entertainment because it allows you to change your location, which gives you the opportunity to get better deals and to access content that may not be available in your region. Atlas VPN is available to use on unlimited devices for one subscription, and Atlas VPN is currently offering an amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. So to purchase this exclusive Joe Blogs offer, please click in the description below. As a direct result of the failure of 2 banks within 72 hours in the USA, the Federal Reserve announced a bank term funding program, which will offer loans with maturities of up to 1 year to banks, saving associations, credit unions, and other eligible depository institutions. The loans will be provided to any institution that pledges US Treasury bonds, mortgage-backed securities, and any other qualifying asset. And the key issue with regards to the terms of this deal is that all of these assets will be valued at par. So that means that institutions will be able to borrow 100% of the original value of those bonds, even if the bonds are now trading below par. And this, of course, was one of the key problems that Silicon Valley Bank, Silvergate Bank, and Signature Bank had experienced. Over the course of the last 3 years, all 3 of those banks had increased their customer deposits significantly because a lot of the companies that they were targeting had large amounts of cash. And in order to try to make a return on that cash, over the course of the last 3 years, all of those banks were investing into US government bonds. But the problem that they had was that the timing of the purchase of those bonds coincided with the COVID-19 pandemic and interest rates being reduced to virtually zero all across the world. So that meant that those institutions were buying bonds with a very low yield. And as interest rates have risen rapidly over the course of the last 12 months, that means that all of those bonds are now trading below par. And when both Silicon Valley Bank and Signature Bank started to experience a run on their accounts with customers wanting to remove all of their funds, the only way that those banks were able to access any cash was by selling those bonds. And because those bonds were trading below the price that the banks had paid for them, that meant that they had to sell them at a loss and then announce to the market that they were booking losses on the sale of assets. And of course, that just increased the panic further, because you can see a bank that doesn't have any cash and the only assets that it has are trading below face value. So the terms of this scheme allows banks and institutions to be able to take a loan against the full original value of those bonds. It doesn't matter what the market value is, they will get 100% of the original price that they paid. And of course, from the Federal Reserve's point of view, there's a certain element of circularity here, because it's lending money against bonds that it's issued. So it knows it's good for the money. It's coming out of the same pot, essentially. In terms of the interest rate that will be charged on these loans, it will be set at the 1-year overnight index swap rate plus 10 basis points and will be fixed for the term of the advance on the day that the advance is made. And the current 1-year overnight index swap rate is 4.9%, so that would mean that any institution taking out a loan today would have to pay 5% interest. The loans will be provided by the Fed's 12 regional banks and will be backstopped with a $25 billion facility from the US Treasury's Exchange Stabilization Fund. However, the Fed says that it does not expect to have to tap those funds because loans under the program are full recourse, meaning the central bank can seize all of the pledged collateral in the event of failure to repay. So at face value, this scheme looks fantastic from a depositor's perspective. It means that you are now fully guaranteed on any amount that you deposit with any institution. But I think when you take a step back, there are three major issues with this scheme. The first is the amount of cash that's available. The second is the point that was made by Kevin O'Leary at the beginning of this video, that this effectively is nationalising the risk relating to all of these banks. And thirdly, there's the additional associated regulations that are now going to be brought in that will now apply to all of the smaller banks. It's estimated that the current size of uninsured deposits in the USA is over $1 trillion. So that means that there is $1 trillion sitting in bank accounts all across the USA that wasn't secured under the previous scheme, which had a maximum limit of $250,000. Now, as we've just discussed, the Fed has set aside $25 billion as a backstop to cover any potential liabilities under the scheme. However, that equates to 2.5% of the $1 trillion that was previously uninsured. So obviously, when you do the math and work things through, if everybody was to claim under this scheme, it's absolutely impossible for the Fed to be able to meet all of those claims because it's covering a very small percentage. Now, obviously, this scheme was put in place really to calm everybody down, to allay everybody's fears. That's what it's been designed for. It hasn't actually been put in place to provide 100% guarantee for absolutely every dollar that's sitting in American bank accounts, because it's just not feasible to be able to do that. Now, I think the second issue with regards to nationalisation is really interesting, because capitalism works on the basis of companies having to fend for themselves. You have to make profit in order to survive. If you don't make profit, then your company will fail and you will go out of business. But what we've got now is a situation in the USA where all of these bank deposits are now guaranteed by the state. So that means that potentially a lot of banks now can take more risk. They'll be able to do things that previously they wouldn't do because they were concerned that they wouldn't be able to return all of the money to depositors. But now that the guarantee is sitting behind all of those deposits, it potentially opens up the opportunity for banks to start taking more risk, to try to make higher returns so that they can all get paid bigger bonuses. And if it doesn't come off, well, nobody's going to lose out apart from the Fed. So everyone's a winner. That potentially could be a mindset of some of the smaller banks. Now, obviously, when the scheme was put together, the Fed wasn't intending to remove responsibility from banks and to let them go crazy in terms of their investment strategies. But a knock-on consequence of this is that depositors are now fully protected by the state, and so banks can take a bit more risk and try to get their returns up in order to line their own pockets. Now, I'm absolutely positive that the regulators have woken up to this fact and that they will now bring in new regulations relating to the banks. The Federal Reserve is now considering tougher rules and oversight for mid-sized banks. A review of the failure of Silicon Valley Bank, currently being conducted by Fed Vice Chair for Supervision Michael Barr, could lead to strengthening rules on banks in the $100 billion to $250 billion range. The Wall Street Journal has reported that the Fed is now reconsidering regulations regarding mid-sized banks, which could lead to more stringent capital and liquidity requirements and potentially beefed up annual stress tests. Currently, the toughest capital and liquidity requirements are reserved for the nation's largest banks. After a 2018 deregulation law eased those rules for smaller firms. Larger firms also face more frequent and rigorous stress testing and accounting requirements. All of those requirements could now be reworked by the Fed in the aftermath of the Silicon Valley collapse, which has also spurred fresh calls for tougher rules for regulators. So you may be sitting there thinking this is good news, that more rules and more regulations will help everybody because it's going to stop those crazy bankers doing things that they shouldn't be doing, losing people's money and causing problems for the economy. But one of the issues that smaller banks have by nature is that it's more difficult to make profit. If you're a large organisation, you can take a very small percentage profit from a huge number of people to equate to a good size profit. But the smaller the bank, the smaller the number of customers, and therefore it's more difficult to actually generate sufficient profit because you've got less customers to cover all of your fixed costs. By increasing the rules and regulations for these organisations, it will potentially reduce their profitability by having to have higher capital ratios, and also will increase their costs because they'll have to report more, they'll have to employ more compliance officers and regulators and people like that. So overall, the impact of these changes could be really detrimental to some of these smaller organisations. And we could see some of these banks going out of business due to the fact that they're no longer making any profit from their bread and butter business. And this therefore could potentially lead to a reduction in competition. And all of this plays into the hands of the big boys. The bigger banks have more customers, more scale, and they already have full regulation. So they're not at risk of increased regulation. So they will benefit in the long term. And if heavy regulations are brought in, partly as a result of these changes, then we could see some of these smaller and mid-sized banks disappearing entirely from the high streets. And it will be interesting to see what happens over the course of the next 6 to 12 months and whether or not we start to see some of these smaller and mid-sized banks posting either reduced profits or even losses. As we discussed at the start of the video, one of the reasons that Silicon Valley Bank failed was that it had a run on its bank accounts, it needed to realise some cash from its portfolio. The only realisable assets that the bank had was a portfolio of bonds that were trading below par. They were forced to make that sale and booked a loss of $1.8 billion. And as soon as Silicon Valley Bank made that announcement, it caused mass panic amongst all of its customers. It led to the bank run and therefore the collapse of the institution. So that was obviously all really bad news from Silicon Bank's point of view. But on the flip side of that transaction, the counterparty that bought those bonds got a very good deal. They potentially will make $1.8 billion profit if they can hold all of those bonds through to maturity and be paid out in full. And you'll be delighted to hear that the counterparty on the other side of that transaction was Goldman Sachs. In a regulatory filing, SVB said that Goldman Sachs bought $21.45 billion of its securities, which had a book value of just under $24 billion, so that represents potential profit of $2.5 billion, and the portfolio consisted largely of US Treasuries and mortgage-backed securities. So obviously that's really good news for Goldman Sachs, and I'm sure everybody is delighted for them.
HSBC is stepping in to help calm nerves over failed US lender Silicon Valley Bank. The banking giant will acquire the UK operations of SVB for a token £1, or just over $1. On Monday, HSBC Chief Executive Noel Quinn said acquiring SVB UK made strategic sense. The Bank of England said the UK banking system was safe, sound and well capitalised. It said no other lenders in the country were materially affected. The deal brings to an end a frantic weekend of talks between government, regulators and prospective buyers. On Monday, UK Finance Minister Jeremy Hunt said ministers had to act to save the country's tech sector.
We were faced with a situation where we could have seen some of our most important companies, our most strategic companies, wiped out, and that would have been extremely dangerous. We have built, over the last decade, the third largest tech economy in the world, after only China and the United States. So it's very important to us as a country that this sector thrives.
SVB UK had loans of around $6.6 billion as of late last week, and HSBC says the takeover completes immediately. However, the collapse of the US lender has raised jitters over the health of the whole sector.
Unlike the majority of other overseas offices, the UK arm of SVB had been established as a separate subsidiary, so this was a limited company in the UK. And on the 10th of March, which was the date that the American parent collapsed, it had total assets of $8.8 billion, loans outstanding of around $6 billion, and customer deposits of $6.7 billion. On the 10th of March, the Bank of England announced its intention to apply to the courts to place Silicon Valley Bank UK Limited into a bank insolvency procedure, which would have provided protection of up to £85,000 on individual deposits. The plan at that stage was that all other assets and liabilities would be managed in the insolvency by the bank liquidators and recoveries distributed to the creditors. However, over the course of the weekend, the Bank of England had discussions with a variety of different banks and investment houses. And on the 13th of March, it was announced that the UK subsidiary of SVB had been sold to HSBC for the token amount of £1. It was also announced that all depositors' money was safe and secure as a result of the transaction, and that SVB UK would continue to operate as normal, and that customers of the bank would not notice any change to their circumstances. Britain's Finance Minister Jeremy Hunt said HSBC is Europe's largest bank, and SVB UK customers should feel assured by the strength, safety and security that brings them. Now, this transaction is really interesting because HSBC have paid £1, which is around $1.20, for a bank with assets of $8.8 billion. Now, just to recap on the situation for SVB, the reason that the bank failed wasn't because that it had lost a lot of money on loans or other assets. It was because of a lack of confidence. Customers in the USA became nervous about the bank's liquidity situation and therefore started to move out all of their balances. That led to a run on the bank, which ultimately led to its closure. But when you look at the UK arm was performing fine. There wasn't a run on the bank in the UK. And actually, when you look at the balance sheet, it's in a very healthy situation. So from HSBC's point of view, buying $8.8 billion worth of assets for £1 represents an unbelievably profitable transaction. When one bank buys another bank, there's usually an enormous amount of due diligence and research and lots of people involved doing all sorts of investigations. However, when you've only got one day to make the decision, you can't do any of that. But when you're being offered $8.8 billion worth of assets for $1.20, that sounds like a great deal for anybody, and HSBC have piled in and completed on this transaction.
Germany is among nations scrambling to react to the collapse of US lender Silicon Valley Bank. On Monday, the country's financial markets regulator said it was imposing a moratorium on the bank's branch there. BaFin said the situation posed no threat to financial stability. But that didn't do much to reassure investors, with European bank stocks tumbling.
Outside of the UK, the only other overseas office that wasn't just a branch of SVB was based in China, which was 50-50 owned between SVB and the local banking partner Shanghai Pudong Development Bank. No official announcement has yet been made, and the bank is continuing to trade as normal. In terms of the other overseas branches, it's been announced that the office in Israel has been closed and 40 employees have been released. The assets of the bank in Canada were initially frozen by the authorities, in exactly the same way as they were in Germany, and similar action was taken in Denmark and Sweden. The situation in the USA is that all of the deposits have been transferred to a bridge bank, and the authorities are currently looking for a buyer for the SVB brand. However, it's considered to be quite unlikely that any bank will want to take on the brand now that the name has been tarnished, so it's likely that over the next few weeks all of the overseas offices will be closed. So what's the summary and conclusion today? Well, I wanted to post this video because we've had a lot of excitement in the world of banking and finance over the course of the last week. We've seen 3 American banks collapse, and we've seen the Federal Reserve introducing a brand new policy which basically guarantees every single dollar of every single deposit in the US banks. And at face value, that's absolutely fantastic news for depositors. But as with anything, there's always implications. There are always side effects for anything that's brought in. And the immediate side effect of the change in these rules are that it removes all of the risk for all of the small and mid-sized banks. However, the authorities are obviously aware of this, and they are currently in the process of changing the rules and regulations. And it's likely that things are going to get much tougher for the smaller institutions. It's likely that everything's going to become more expensive in terms of all their regulatory compliance and their capital requirements. And therefore, it's likely that they will make less profit. And potentially this change in the rules could put a number of these banks out of business. So what we're seeing at the moment is a change in the financial environment, and all of this is playing into the hands of the big boys. As we've seen in today's video, two of the biggest winners over the course of the last 7 days have been Goldman Sachs, who bought a portfolio of bonds at a discount of around $2.5 billion to face value, and HSBC, that bought a bank in the UK that had total assets of around $8.8 billion for $1.20. And I think over the course of the next 6 to 12 months, we will see changes in the regulatory environment that will play to the strengths of the big financial institutions. And of course, the fundamental issue that started all of these problems was that customers became nervous about the smaller banks. That's why there were runs on those banks, because people were trying to take their money out. And banking fundamentally relies upon trust and confidence. And once you lose both of those factors, you're in big trouble. And the failure of these three banks has increased the level of nervousness. And people are now moving towards the bigger banks because they believe that their money will be safer with them. So overall, I think what we've seen in the course of the last week or so is that the frailty of the smaller banks has been exposed. People are now more nervous about where they're putting their money. Everybody's focusing in on the financial viability of their institution. And I think in the longer term, it's likely that we will see more movement of assets away from the smaller players towards the bigger players. And we could very well see more of these smaller banks failing, because all it takes is another rumour, another loss of confidence, another bank run, and we could find ourselves in exactly the same situation as we did last week with Silicon Valley Bank. So hopefully you've enjoyed today's video. You found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. And thank you for watching this video all the way through to the end. And as always, here's a bit of fun just to finish off with.